We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Let's get to the top stories today. A cautious start to trading in the Asia-Pacific after a sell-off in U.S. Treasuries. You have inflation risks sparking bets that the Fed won't cut rates before July.
And key Chinese ministries are set to unveil more details of large-scale equipment upgrades and consumer goods trade-in programs as part of measures to boost consumption.
And Samsung Electronics in focus with quarterly profit missing estimates quite badly here as it struggles to regain market share in AI chips and also in smartphones. Welcome to the show. Not as bad, actually, as what I think the initial pricing was suggesting here, and might be down to the fact that you have the likes of Samsung bottom of your screens right now, open 1% lower, and as you can see, it's reversed completely right now. Kospi is about flat. Put everything in aggregate right now, including where you are with Taiwan, we're down about 0.5%. A lot of that has to do with obviously Taiwan and also with the Nikkei 225. I would imagine, though, when you look at China today, that might present an additional drag on the benchmark. The problem? These two right here, yields on the way up, 4.3 to about 4.7%, just about across the curve. You are seeing a catch-up trade as far as yields go here in the Asia-Pacific. You have a stronger dollar still, which we'll talk about in a moment here. Now, speaking of the Fed, right, we mentioned this. So no cuts currently priced, and this is a moving target. The full cut is priced in July, so wait for the summer, I guess, is the expectation there. Now, the other iteration of this really, and this is your pain point and why the dollar is stronger, and this is, I guess, one other yield to watch. Let's have a look at that, please. 5-year forwards on the 1 year. We're now above 4%. We're pushing to 5.2%. We're nearing the high at the height of the tightening cycle of the Fed. So expectations for interest rates in the U.S., your pain point across these markets, are continuing to climb. That's up 120 basis points from September. So give or take, you could maybe put that down to Donald Trump and the re-election there. Now, speaking of China, so own set of problems. The lack of catalyst so far. We had this joint briefing, of course, in the top of the next hour. You have the Tencent story, which didn't help, and a further decline overnight. A50 futures are flat. You have a 10-year yield at 1.62%. And dollar China, of course, Rebecca, we've been talking about this, the fixing, and maybe when you look at some signs here in Hong Kong of, the CNH HIBOR on the way up might indicate they're in the markets, you're squeezing some of the shorts. Who knows? Yeah, really interesting. I mean, it does look like the PBOC is zeroing in on focusing on stabilizing the yuan here at that 7.19 level. Effectively, that means the USD CNY rate is capped to the ceiling at around 7.33. But as Dave says, the HIBOR here, CNH HIBOR, overnight yuan borrowing costs in Hong Kong soaring to above 8%. That's the highest since 2021. So keep looking at that potentially, whether or not we get to that other spike that we saw, that was back in 2017, perhaps suggesting that authorities are, squeezing, trying to curb that one-sided speculation there. Just want to connect the dots here to some of the bigger picture that we're seeing. The dilemma for the PBOC, on the one hand, they want to control and stabilize the currency. On the other hand, they also want to lower rates and try and stimulate the economy. They're not able to do that without kind of spurring further yields, of course. And so there is this sort of conundrum, and that is deeply connected to the consumption and the deflation story. We had this briefing today, PBOC, MOF, NDRC, all the big players coming out to talk more about this trade and consumption program. Let's see if it's enough to try and get stocks going again. We're watching them very, very closely today. Onshore, we've had a falling turnover, hitting a 3-month low, as well as that key HSI. We could go to the November low there, waiting to see whether or not perhaps this briefing can stop that from happening. Yeah, we'll see. Well, 19,054 is a level to track, as Rebecca was pointing out there. We've had this honeymoon period between markets and briefings. We're now moving into the marriage phase of this, and we're looking for evidence, really, that this marriage is going to work. Helen joins us right now, Managing Director, CIO, and of Trinity. Why don't we start with China, since that seems to be one of the pain points in these markets. So we have a briefing coming up. Why do I get a sense that markets are looking beyond these announcements now, looking for something that's actually worked in the economy?
Good point, because we've had a lot of briefings already over the last 12 to 18 months. A lot of policies have been announced, and people, I think, are not yet satisfied with the results. I do think that since basically around October and November of last year, after that one big bang set of briefings in late September, I think the sentiment has picked up, the confidence has been reinforced, and we've started to see some evidence of virtuous feedback loops start to play out in the economy. So you look at consumption, travel, housing market, they're no longer kind of slipping like this, they're kind of stabilizing, but no real recovery just yet. I think right now people are getting a little bit tired of these briefings. They're thinking, well, you know, the key overhang is really the trade and a lot of the geopolitical issues, right? So the domestic, stimulation is obviously important and useful, but that's not going to be enough. So I think most of the attention is going to be on the external factors.
Just to pick up on that question of trade, I mean, we're going to go into this period, sort of 3 to 6 months, where the US is formulating its policy. We're also still a couple of months off the Liang Hui, the 2 sessions in March. How are you approaching trading in this sort of quite odd limbo season that we're in?
I think it's very difficult because I think specific to China, I think we'll just be range bound for a bit of time. The main reason is because, as I mentioned, people are waiting for the verdict in terms of the trade. I personally hope that Trump is going to take a more practical approach to this because it's not just about China, it's actually about the rest of the world as well. If he can actually try to gain some momentum on the trade negotiations with all the different counterparties, be it China, Europe, Mexico, Canada, etc., early on in the administration and settle all of these potential tail risks that people are afraid of, maybe that will help in terms of not only stabilizing the confidence for the U.S., but also the rest of the world, and we can have a little bit of a catch-up from the rest of the world and a synchronized recovery if it's not as bad as the headline numbers that he had previously talked about, right? But if he actually drags this out and there's a lot of uncertainty for everybody, people don't know what to order, people don't know how to behave, consumers don't really know, what the second half of this year is going to look like, whether they're going to have jobs. And so I think that actually ends up being a huge headwind for the entire global economy. So I hope that's not the scenario that we actually end up seeing.
I mean, he's even talking about, I think, renaming it Gulf, the Gulf of Mexico, taking over Greenland, what have you. Obviously, extreme examples of this uncertainty out there. What is the risk to the U.S. economy? Is it a growth-oriented policy that you think is coming out, or is it the opposite, you think?
Well, certainly the markets have been very upbeat in terms of all the growth, pro-growth policies that have been talked about, right? So after Trump, after the red sweep, everything really rallied pretty aggressively. And recently we've started to see small business sentiment start to pick up. We see, certain indicators of consumption picking up. If you look at the travel leisure space, for example, services are still on fire, right? That's where a lot of the inflationary concerns are coming from as well. But I think at the end of the day, you have to see whether this is going to sustain. And so the good Trump aspects of the policy are already out, well known, and largely priced in a lot of stocks. But the bad Trump, which comes in the form of tariffs as well as immigration policy, is still a huge unknown. Now, on the tariff front, you've got basically growth risk as well as inflation risk. On the immigration policy, it's mostly growth risk if a lot of labor actually suddenly disappears and the labor market was already tight in the first place. And obviously, a lot of the market was trading based on some of the labor statistics over the last few months and kind of the firmness of the overall labor market. So I think how he handles these two issues is going to be very important for not only U.S. markets, but global risk assets as everything kind of falls from the U.S. these days.
And, I mean, markets have run with this. I think the initial iteration of this is yields picking up. This Fed meeting that's now, well, the Fed cut, it's now thought to be July for now. That's a moving target. I mean, are we at a point in Treasury yields that it becomes a headwind for risk assets?
If you look at the previous precedent, let's say from 2022, 2023, usually when the treasuries moved up quite a bit, then, equities would start to fall, right? Particularly certain financials and other type of yield-sensitive sectors. But this round, in the last few months, they've been surprisingly resilient because there's been, offsetting benefits assumed from other policies, like, for example, a lot less regulation on the financials after the red sweep and, maybe parts of tech as well. And maybe with the new FTC, there's not going to be so much antitrust concern, so more mergers and acquisitions can happen. So a lot of these assumptions have offset the concerns about the higher yields. But I think if things continue to move up further towards 5% on the 10-year, you will start to see it come through, just like we saw a little bit last night, right? So people do realize that the higher yields is not going to be beneficial to many aspects of the economy, including, for example, the housing market, where mortgage applications and new starts and so on continue to stall. So I do think it's something that we have to take into consideration, and that that is starting to become a risk to the U.S. market as well as risk assets globally.
The other side of that story on yields is, China yields. Of course, we have now the widest ever discount differential between China and the U.S.
Whoever would have thought?
It's extraordinary to see. We have the likes of Lombard saying that China 10-year is going to test the 1%, even more extreme projections that it could get near zero. What is your expectation? How low do we go on China 10-year?
I mean, honestly, I thought that 2% was the bottom because, like where we are right now is kind of like, where things were in the U.S. during COVID when it was basically like, 0% interest rate at the front end, right? So, and actually in China's case, I don't think a very low 10-year or beyond is really that helpful to the economy because it's not like corporates are not really financing anything in China based on 10-year. They're usually all, operating on kind of like 3-year floating rate or 2-year or even shorter bank loans. So, having a low 10-year doesn't necessarily help the economy directly as it does maybe elsewhere in the world. And that's part of the reason why the PBOC came out, as early as second quarter of last year to basically do some yield curve management and say, actually the curve should be a lot steeper. Actually, there's going to be a lot of supply at the long end. And actually, the economy is not as bad as the, long end of the curve should suggest. So I think actually it's probably overshot a little bit, and I do think that as the economy stabilizes and potentially picks up or the trade rhetoric gets a little bit less hawkish, I do think the 10-year will start to pick up a little bit, and hopefully that will, reduce that yield differential a little bit, albeit, as you mentioned, it's probably at historical wide. I mean, it used to be the case that China was way higher than the U.S. for many, many, many years, and now it's totally the opposite and to a very extreme level.
Even now Japan is higher than China on the 30-year yield. Anyway,
Helen, stay with us. You'll be joining us for more. We'll have more with Helen Zhu, Managing Director and CIO of Trinity. Now, still ahead, investors in China's $11 trillion government bond market are increasingly concerned about getting locked into a deflationary spiral. More coming up in today's Big Take. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is The China Show.
Okay, welcome back. We're about 15 minutes away from the opening bell. We'll call it flat. I'm curious to see how Tencent actually trades following the 7-8% drop that we had yesterday. Of course, there's a briefing coming through, and the CSI 300 consumer discretionary, there we go, benchmark actually moved against the grain yesterday. So let's see. Still with us here is Helen Zhu, Managing Director and CIO of Trinity. We were just talking during the break, and I was just looking at this JP Morgan note which just dropped. They're recommending Chinese banking stocks to outperform because of dividends. How do you think about the dividend income strategies, which has worked well? How do you think about them this year, for example?
I think in China, actually, the dividend income strategy has already worked extremely well for the last few years, right? Particularly on the central SOEs. So if you actually look at banks, if you look at telcos, if you look at oil stocks, I mean, they're the best performers by far versus cyclicals, new economy, internet, et cetera. Consumer obviously crashed last year as well. So I think that's not a new story for China. In the A-share market now, the dividend yield for banks and telcos is around 4.5% versus maybe 6% plus a year ago. And in the Hong Kong market, it's now maybe around 6% versus maybe 8% a year ago. So I think not as interesting, but obviously that makes sense given how the CGB has moved down, like we talked about. So the spread over the CGB is still relatively reasonable, and people think that these are relatively safe. So I think until there's a meaningful inflection in terms of the economic cycle or an overhang lift, probably these guys will still sustain and be quite okay, and people are happy with getting that mid-single-digit return. I would say in the U.S., we're getting much more interested just because defensives and dividend-yielding stocks have been so out of favor. Like, nobody's wanted to touch them for a long time. Why buy those if you can get 4 or 5% in terms of your fixed deposit rate, right? So, but I think as the U.S. now has very low expectations on interest rate cut, so people have no positioning in these yield names at all. If the interest rate does come down, if the economy starts to weaken to any kind of extent, then people will definitely get more interested. So for a while, for example, we were looking at U.S. telco versus Chinese telco. They were trading at the same valuation, whereas everything else in the U.S. was like 3 times the PE of anything in China, right? So for a period last time, you were getting U.S. telcos for like 8% dividend yield. And even now, even though the dividend yield has come off, they've actually upped some of the share buyback. So the total cash return you're getting is still kind of like high single digit. Now, if U.S., for some reason, the economy starts to slow down, people don't want to be in the punchiest part of the economy anymore, I think there could be rotation into defensives, and that would benefit the dividend yielding strategies.
I'm just looking at the yuan fix here that's coming through, really robust fix. Still at that 7.1, well, it's 7.1 effectively that we were talking about. PBOC, again, apparently determined to keep it at that level. Thinking about the yuan and the management of the yuan, you know, one issue is that we haven't really seen it weaken against the dollar. It's continued to weaken. We haven't seen it weaken against its basket of peers and other trading partners for China. I mean, where do we go from here? How do authorities navigate their way through this, particularly with this tariff overhang that you've mentioned? As
you mentioned, basically a lot of the depreciation, or most of the depreciation, is because of U.S. dollar strength, not necessarily because of RMB weakness, where RMB's actually outperformed the euro, outperformed the Japanese yen, and obviously outperformed most of the other Asian and emerging market currencies. And that's precisely, as you said, because the PBOC is working so hard on defending the currency. Now, theoretically, if your economy is slowing and you want to boost exports, et cetera, you want to weaken your currency. But given that we're going into the trade negotiations potentially, one thing that you definitely do not want is accusations of competitive depreciation, right? Which is something that the U.S. has not accused China of in a very, very long time. And I do think that China recognizes that as part of the trade negotiation, the U.S. is going to have certain demands on this. Because if you do impose tariffs, but then it's immediately offset by a massive depreciation, then that kind of defeats the purpose, right? So I think that'll be part of the consideration. The other thing that China has as part of its rationale is that if you have a meaningful depreciation, that's going to exacerbate the capital outflow pressure and potentially weaken the economy further. So they really have to balance things in a very kind of cautious and conscious way to make sure that there's two-way expectation on the RMB, even as we're going through a period of weaker economy and U.S. dollar strength, as well as uncertainty on the trade front.
The other geopolitical risk that frankly wasn't on the radar up until yesterday was, you know, the Tencent example, and suddenly it's, you know, China's most valuable company is in the crosshairs of, you know, military conversations. Is that something that you think we should be cognizant of?
You know, these U.S. government lists have been around for a number of years, and we've seen a lot of companies coming onto them and a few coming off of them after they appealed. So, for example, Xiaomi was placed on such a list back a couple of years ago, but after 4 months of appeal, they were taken off. Obviously, the political environment nowadays is much tougher versus a couple of years ago as well. I think the current list, which is basically just talking about Pentagon procurement, is not so harmful, but I think the market is reading beyond it and wondering if more companies are going to go onto not only this list, but eventually migrate onto other lists, which actually mean that either U.S. investors can't, you know, invest in the stocks, or maybe, you know, U.S. buyers cannot procure from these companies in a more general sense beyond just the government procurement. That would be more damaging. If you actually look at the overlaps between these different types of lists, there are definitely companies that are on one list that eventually get onto the other list, but not necessarily so, right? So I think it opens the door for imagination for a lot of further downside for many Chinese companies. It depends on the sector, right? So back when China Telecom, China Mobile were sanctioned back in 2018 from U.S. investment, it wasn't a huge deal to the share price because actually the ADR was not that liquid. There wasn't a lot of foreign shareholding anyways. For a lot of the internet companies and consumer companies, that could become a bigger consideration. So I don't think it's a given that this happens, but the market certainly is more worried about it versus before, and for a good reason.
Yeah, this anxiety that being put on the list is really the starting point of an escalation.
Exactly. And that's why I was saying that it's less about the earnings and necessarily the domestic policy, but the China market would depend more on resolution of these geopolitical tensions, because that's going to more directly hit your outlook.
I mean, to what extent are you concerned about U.S. companies also being caught in the crosshairs of this decoupling? I'm thinking, for example, TikTok, you know, we have all of these videos talking about ways to avoid the ban, and that implicates Apple, implicates Google, and how they're going to implement, how they're going to enforce.
Look, I think U.S. companies still have a lot of vested interests and sales in China, and they definitely do not want the relationship to erode further. So I do think there is more lobbying to, the practical side of Trump as well, because, if Apple, breaks up with China, it's not going to be good for the S&P, and, Trump cares a lot about the S&P and the NASDAQ. But I think from China's side, there is not going to be a lot of incentive to try to strike back or try to retaliate through discriminating against the U.S. companies or, basically fanning nationalistic furor against U.S. companies. I think that would actually only backfire and shoot themselves in the foot. So to that extent, I don't expect much direct negative, but, we'll have to see because certainly anything's possible.
Okay, well, I actually had a follow-up there. We could talk about it next time. Helen, thank you so much. Helen, you were out of time. Managing Director, CIO at Trinity. Okay, 19,400 and Hang Seng Index going into the open today. So we're called lower on the benchmark. Again, the fixing coming in, quite a substantial gap from the estimates. Plenty more ahead. This is Bloomberg. Some final thoughts from Helen Ju joining us right now, still on set from Trinity. We were talking about the risk to U.S. equities from the geopolitics. There's a risk, though, that U.S. policy becomes restrictive to U.S. companies doing business in China. Is that a risk I should be thinking about?
Oh, absolutely. I mean, one of the things that people were talking about yesterday is, if things get worse, CATL, for example, was also put on the same list as Tencent. And obviously, right now, the U.S. government isn't procuring from them. But what if in the future, Tesla's not allowed to procure from them? Then what happens to Tesla? What happens to the global supply chain? And there's not a lot of substitutes for CATL, and the Korean and Japanese alternatives can't come up with the supply in time to meet all of their needs. So if that's the case, it would definitely be negative for companies like Tesla, like Apple, like many of the other major names in the U.S. indices that have performed spectacularly well and have been holding up the indices. So that's something that I think that the new incoming administration has to take into consideration as well.
Okay. Thank you, Helen. Have a great rest of the 2025, of course. More conversations come there with Helen Ju, Managing Director at CIO and Trinity. Going into the open today, just 30 seconds away. Well, 3 minutes and 30 seconds to be more exact here. 0.3%, 19.3. So we're headed down. By the way, the weather forecast suggests if you're in Hong Kong, the weather is temperature is headed down towards the end of this week. So
stay warm.
Stay warm. Time to get those boots out, if not already. No, they are. I hear them a lot on the street. A little bit too much, in fact. But it's a fashion thing more than it is utility, isn't it? I'll leave you with that thought going into the open today. This is The China Show.
Welcome back. You're watching The China Show. We are counting down to the open of markets here, Dave.
Yeah, not a lot of action. In fact, I'm going to do a bit of a word salad here, wordplay, if you will. So at the top of the next hour, we're looking at this joint briefing. We're looking ahead to that. We'll see what they announce. It's a PBOC, Ministry of Finance, NDRC. It's the trade-in policy. And, hopefully, I think one of our guests this week has pointed out that we might finally be able to see how large that program actually is. It's been in place for some time. How much refrigerators do you actually need and how much you need to replace them. The reason that's important from just a sort of word salad perspective is that's where trading is taking place. The reason I bring that up is when you look at onshore markets coming online, trading turnover, there's the connection there, actually fell to the lowest since the week that PBOC came out and signaled this entire policy pivot from late September. In fact, the turnover, which I'll show you later, was just over 1 trillion renminbi. That's overall in mainland China. That does sound a lot. It is a lot compared to sort of your multi-year average pre-September last year, but it's certainly much lower than what we've gotten used to really over the past few months or so. Anyway, more on that in a moment, but I think I gave away the thunder there. 0.5% to the downside. We did close higher, though, in onshore markets yesterday. A glance, of course, at some of the big names. Bottom of your screens, your 10-year yield is now flat, still at 1.61%. We did have a fairly hefty fixing coming out of the PBOC today. That's number one. And number two is really, as Rebecca was just pointing out as well earlier on, you want to watch CNH HIBOR today. That's effectively the cost of borrowing the currency overnight. 8 percentage points yesterday, 8% north of that. So I think we get a fixing in about 2 hours from that. We'll see what that looks like. Have a look at Hong Kong. And speaking of CNH and the markets there, the currency is supposed to be coming here. Dollar Hong Kong, as you can see, as well. 10 cent is still down after the 7-8% drop yesterday, a further 2% today. Hasn't found a floor just yet. We did see a similar losses overnight in 10 cent. 1954 is the level you want to watch. The reason that's important, so about 300 points or so. So that's the low that we hit after this entire new trading range we hit. So we are actually at the very low end of the trading sort of range, and we could set that new low if, in fact, we do take that level out by the end of the session today. Very quickly, as promised, here's market turnover for you. 1 trillion is demarked horizontally here, coming up on your screens. There we go. This is what we've gotten used to so far. That's your initial spike in euphoria. That's when the initial press briefing took place out of the PBOC. That's where we are. Just over 1 trillion. First couple of days of 2025. And as you can see, that takes you literally all the way back to that very week. So we'll see what happens with that. And certainly, you know, as we wait for catalysts like, you know, earnings, more policy pronouncements, Rebecca. In the absence of earnings or even inflation stay, which I believe comes out this time tomorrow, you know, we expect this to remain range-bound, as our previous guest just pointed out as well.
Yeah, absolutely. And a big theme here for us watching this, of course, is the deflation story, especially as we go into this briefing. You know, are we really going to see a lot to boost consumption here? So investors in Chinese bond market have never been so pessimistic. We have some now piling into these bets on a deflationary spiral. Joining us today, Asia credit editor Finbar Flynn comes to us from Tokyo to discuss what this means for the world's second largest economy. Really excellent reporting here. I mean, Finbar, just tell us first, why are people becoming so concerned about the risks of Japanification in China's bond market right now?
Good morning. Yes, I think the indexes that you guys cite every day are really, you know, telling this story. So at the end of last year, I suppose maybe November, we saw that the 30-year bond yield for Japan and China crossed. So that was a huge moment in itself. But now we're actually seeing that on the 30-year bond spread differential between Japan and China, there's a 40 basis point difference there now. And with the US 10-year yield, it's over 300 basis point difference. So we're seeing these massive changes in the bond market. And you see every day that the 10-year yield for the Chinese government bond is reaching new lows. So it really is, you know, a momentous occasion, and the deflationary pressures that you mentioned as well. We may see again tomorrow that prices for producer prices may fall for the 27th month, and consumer prices are just bobbing along at like 0.1%. So these are acute deflationary pressures.
Yeah, and Finbar, I mean, part of this too is where you are with, you know, demographics, which I guess we'll get to in a moment. But, you know, I think before we get to the next question, I think to the point you were just making there, we did speak with Nomura's Richard Koo. A lot of people know him, of course, in the market. And he really talked about what I just mentioned, the demographic shifts we are seeing and are weighing down right now structurally on the Chinese economy. Let's have a listen to that.
Given that, you know, Chinese population is also shrinking, starting on the same year the bubble burst, you know, these things if you put these things together, that the bottom that people really feel safe to re-enter the market might be, you know, far lower than under ordinary circumstances. Certainly, government doing all sorts of things are helpful, but whether that will actually result in real bottoming out and recovery of the real estate market, I'm still quite doubtful.
Yeah, and Finbar, we're showing a graphic here. This is the working age population in Japan. We know, of course, the economy's been shrinking. This matters to the economy specifically. I'm just doing rough math here. I think we've shrunk about 15, if not 20% from the peak in the early 90s. My question to you, Finbar, is are we seeing a similar phenomenon take place in the labor market in China that we saw in Japan 3 decades back?
So it's an interesting question. One important point is that where we are in China now, the population is decreasing. And we're still at, I suppose, the front end of this multi-phase new era for Chinese bonds. But in Japan, the population only started to decrease halfway through the 30 years of lost productivity. So Japan's economy, Japan's population was still increasing. The population was still increasing in the 1990s, whereas China's isn't. So a lot of people say actually China is in a lot worse position now in terms of the demographics. I suppose on the flip side of that, the population. China still has a very much larger urban population, and that is something that is significantly different from Japan. So you could expect larger productivity gains from more urban growth from people moving from the rural areas into the urban cities.
Just quickly on this question of what China is actually doing to rectify this. Your story tells this so well. The longer you take to fix deflation, the more expensive it becomes to fix that problem. What are authorities doing?
Indeed, I think that is really the crux of the issue, and that's something that Goldman pointed out last year, that what happened in Japan is you had this deep negative, loop, and negative feedback loop. And we've seen in the last month that the Chinese authorities, it's not quite, the Draghi moment, whatever it takes, but we're getting quite close, at least verbally, in what they're saying. They want to forcefully and vigorously boost consumption, and we have the Prime Minister also saying that, they want to do everything possible to boost consumption because, they're scared of what Trump may do coming in on terms of exports, so they're focusing a lot more there. And we'll probably see more rate cuts. We'll probably see a lot more fiscal stimulus, although that is something they've held back on to date, to be honest.
Finbar Flynn, thank you so much. Our Asia Credit editor in Tokyo for us. Of course, Finbar is part of that story alongside our colleague, of course, Joanne Huang. And you can check out that big take on the terminal, also on the website. Check it out. Fantastic piece all the way down. Really dissects the story quite nicely and comprehensively. Plenty more ahead. This is Bloomberg. Welcome back. Let's talk about Hyundai Motor and the CEO. So, a conversation with us, of course, here. The car maker, well, they say it's not concerned about how it ranks among its competitors, but it is focused on providing customers with the best product, hopefully. Jose Munoz told us exclusively about the company's strategy in China and his response to the potential merger between Honda and Nissan.
Basically, for us, being number 3, being number 4, being number 2 is not an objective per se. Our key objective is to provide to our customers with the best product, the best technology, which is safe, the best customer experience. The industry today is more competitive than it's been in the past. Already a few years back, there were a lot of talks and a lot of commentary about consolidation as one potential solution to maintain profitable operations. And if you look at the number of technologies that we have today and compared to 5 years ago, you have EV, and you have much more hybrid, you have plug-in hybrids, you have EREV, you have hydrogen. Well, it is really difficult for a single OEM to be able to invest everywhere. So I think we need to be smart in where we invest our money, but at the same time, you cannot lose the opportunity to get access to the best available and future technology by just doing the things by yourself. So I think the concept of the ecosystem and the partnerships we've utilized in addition to the internal development of our own capabilities and technologies, I think we believe that this is the winning proposition, despite the fact that we are the 3rd largest OEM.
What's your strategy for the China market? Because the legacy overseas car makers are struggling, whether it's GM or others, they're losing money after seeing China as the cash cow. It's changed dynamic dramatically. You have a partnership with BAIC Motor. I understand you're going to inject some $1.1 billion into the China JV. Is this money well spent in a market that is losing market share? All the players are losing market share, the foreign car makers.
We have also been impacted very severely by the situation in the Chinese market. And at the moment, we are trying to readjust our position in the market so we can make it a business unit which is profitable, which is worthwhile having. But let me tell you that being in China, it's also a very good way to experience and to appreciate how to improve and also being humble, looking at how competitors are operating in the market to do a better job, right? So, and then to me, the fact that we are one of the OEMs who have decided to stay the course and invest and grow with our partner, which is a great partner, Beijing Auto, we have a very great relationship with. I think it shows our commitment to our customers in China and also in other markets.
But can you leverage it as an export base at a time of threatened and realized tariffs?
I think so, provided we get the right scale to be competitive. It could be for certain markets, but we also have to improve in the domestic market by having the right products that the Chinese consumers like, by having the right positioning, the right distribution, and definitely the competitiveness in terms of price that the Chinese consumer is looking at.
How can you compete against a company like BYD, which is vertically integrated? It, I think, makes its own batteries, about 80% of its own batteries. It has the scale. I mean, a lot of these car makers are not profitable, and that's a political issue as well. It's causing political waves abroad. But how do you compete on price and scale in a market that is dominated by the local players?
Well, we are competing de facto. One thing is to compete, it depends on the market position, and one thing is to compete in China itself, where at the moment the local Chinese are doing a better job than basically anybody else. In other markets...
Unfairly, though?
Nobody really knows, but we do our best within the rules always. But I would say in other markets like Europe, well, we have them as a competitor and we do better than them. You go, for example, Brazil, Latin American markets. We just finished the year and we became number 4 when the Chinese have sold more cars in Brazil than ever in the history. So we are de facto competing with them, and that they are not shortcuts, they are not tricks that you can apply. So you need to be very consistent in terms of having the right economies of scale, having a good quality production capabilities at good cost.
Let's talk about the local situation here right now. Obviously, there's some political unrest here in South Korea with President Yoon under fire. He's been impeached. There's a lot of political uncertainty right now in the presidential office. How is that potentially going to impact consumer sentiment? And as well, it's hit the won quite a bit.
First of all, well, I'm not in the politics in any market, and also not in Korea. We're watching carefully, obviously, and then we're focusing on our business where we have not seen any impact so far. We continue to focus on delivering the customer promise, and then hopefully the situation will be clear very soon. But meanwhile, we focus in every single market, doing our very best for our consumers.
Hyundai Motors CEO Jose Munoz there, speaking to our chief North Asia correspondent Steve Engel. Now, staying on this theme of South Korean companies, Samsung has reported lower than expected profits in the latest quarter as it tries to claw back market share in AI chip and smartphone markets. Let's get more on those earnings with Bloomberg Intelligence Senior Technology Analyst Masahiro Wagasugi. Tell us, what do you make of these latest numbers?
Yes. Regarding Samsung's number, we can see that maybe the non-AI demand is not very strong, and so especially for the NAND flash memory, as Micron, its competitor for Samsung, Micron, suggested that weak demand for NAND flash memory. And also we see that maybe standard DRAM, which are mainly used for the smartphones or PCs, these demand may not be so strong. And in the case of Samsung, they have smartphone business and also display business. So in December quarter, especially for smartphone, it's a kind of a weak season for Samsung. So these products may have some weak result for Samsung for the December quarter. But having said that, Micron already suggested weak numbers, and also maybe the consensus already have came down or quite a bit. So that was not a big surprise for the market.
Masahiro, David here. So when we get the breakdown of the numbers, what are you most curious to see?
Yes, once we get the numbers, we would like to see the numbers for the DRAM business and also NAND flash business. And also we don't have the numbers for breakdown in a foundry or maybe system LSI, but we would like to analyze the breakdown for the semiconductor segment. And regarding March quarter, we will see some new launch for the Galaxy 20 next flagship model. So maybe the mobile segment should be quite important for March quarter. And maybe for other factors, we would like to watch for the news potential approval from Nvidia for the high advanced HBM3E chips for the AI computation. So that could be the potential positive factor for Samsung going forward.
Bloomberg Intelligence Tech Senior Analyst Masahiro Wakasugi there in Tokyo for us with his take on this big miss from the Samsung story. Shares are up, though, in Seoul today. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show midweek session. 30 minutes into the session here, and it's down about 0.2%. Volumes are wanting. Turnover has been extremely low so far this year. Maybe this joint briefing coming up in a couple of minutes might provide a catalyst that markets are looking for. In the meantime, as you can see, we are heading lower as far as prices go, including on the separate side of things, yields. But that's an economic story here, Rebecca. Apart from this, though, of course, there's this tragedy, of course, which took place this week, too.
Yes, yeah. Chinese state media saying that more than 120 people have been killed in Tibet after a 6.8 magnitude earthquake struck on Tuesday morning. Our Greater China Executive Editor, John Liu, joins us from Beijing. John, can you explain why the management of these kind of natural disasters is so sensitive for authorities in China?
Well, the ruling Communist Party wants to be able to show the efficacy with which it can respond to emergency situations, earthquakes, other natural disasters. It's also very important for the government to be seen as being a good caregiver, a good caretaker of people's livelihoods, of their property. And so having a rapid response, having Xi Jinping publicly come out and call for an all-out effort is very important in these situations for not just the people there on the ground in Tibet, but for those around the country to see Beijing reacting quickly and taking all necessary steps to save the people there who have been the victim of this tragic earthquake.
John, do we have a better idea now of the sort of, well, we know that what the death toll is so far, and also the economic damage?
This is a relatively rural area. It's sparsely populated. Tibet itself, it is, just in terms of landmass, it's about twice the size of France, but it's only home to about 3.5 million people, so very, very sparsely populated. This earthquake happened about 9 a.m. Beijing time yesterday. The footage that we've seen shows homes destroyed, land subsidence, doing substantial damage to local roads. The infrastructure, I'm sure, is not in a great condition at the moment. There are rescuers working very hard to try and find those that may still be trapped in the rubble. It's possible that death toll will climb as time goes on. The economic impact, I think, will be, in terms of the overall whole for the all of China, I think will be relatively small.
John, thank you for the update. John Leo there, our executive editor for Greater China in Beijing for us. So in a couple of minutes here, we'll leave that story there for now and, of course, keep you guys updated on any more information there. In the meantime, we also have this economic briefing that is set to happen in a couple of minutes here, and this is a joint briefing between the NDRC, the PBOC, the central bank, the economic planners, the former there, including the Ministry of Finance. So suffice to say, the Avengers of the economy. Suffice to say, expectations are high. That's a question mark.
I think, as we were discussing with Helen Ju a bit earlier, some investors just looking through this, there was a bit of optimism. Essentially, people want to understand the scale and the depth of what's going to happen with this trade-in program.
Yeah.
But, you know, to the theme of the big take today on China's deflationary spiral, the issue is it enough? Can this actually really lift consumption and boost confidence? And, of course, we've been chit-chatting. The longer that you leave these problems, the more expensive they become to solve.
Yeah, and, you know, there's a sense really that we've gotten so far from a lot of the economists, and Goldman Sachs will be joining us in a couple of minutes here, that so far, while it's helped in various specific areas of consumption and categories like appliances and cars, it goes still not as far to addressing the sort of structural issues in the economy. That's coming up next. This is the China Show. Welcome back. You're watching The China Show. We're entering the second hour of the program, half an hour into the session in Hong Kong. On your right, of course, is the Hang Seng Index, 0.6%. Tencent, of course, is a big story, continuing to drop. And within the Tencent story, actually, the biggest buyback from the company on Tuesday following that massive drop in the stock. Biggest buyback, I think, since 2006 out of the company. Tencent, bottom of your screens. On your left, we're waiting for this briefing to begin. You're looking at 1, 2, 3, 4, 5, 6, 7 seats. So that's 6 speakers, including, I would believe, the moderator. So we have the vice head of the NDRC, the PBOC is in there, Ministry of Finance official, an NDRC official, SAMR official, and also out of the MOFCOM. So that's 6 plus 1. So we'll see what they say and who says it, and I guess also who actually shows up is also quite important at this point in time. To help us this hour and give us more context is Belle, of course, Annabelle Droulers, our co-anchor for the rest of this hour. Belle.
Yeah, well, I mean, that's really the big one we're going to be watching for. I mean, look, there's not really big expectations. I think we need to sort of set that out here. People that we're speaking to are saying maybe not big fireworks to come out of that. But you know, the NDRC last week with their press conference talking about expanding the trading program. Yeah, okay, it was expected. We'd see an expansion of it beyond just having white goods, but still we had a significant market reaction because, as we were saying, Xiaomi, for instance, hit a fresh record high. In terms of the market dynamics today, it's also really being directed by the US session overnight, and this is actually a bit of a different story, of course, but really related to these expectations around Fed easing and still being scaled back, and so that really weighed on the session, and you are just seeing pretty much every sector in the red. But this is taking a look at China in particular. Got the CSI 300, 0.4% to the downside today. Other things are weighing as well, Dave, and certainly people are rethinking their economic forecast for next year, or this year rather. Yeah, keep forgetting that it's 2025 already. You know what's going to remind you of that? Gym selfies. A lot of people at the gym. It's early January. Anyway, I've been ranting about that really for some time now, so I probably will stop that for now. In the meantime, to Belle's point, here are the consensus forecasts for 2025 on those various metrics. GDP growth 4.5%, CPI at 0.9%, so on and so forth. Retail sales, of course, very much in focus given what we might be hearing soon here. In fact, I think we are beginning right now out of Beijing, this live briefing. Let's take you straight back there and have a look at the speakers so far taking place. Again, we have 6 speakers, including, I believe, 1 moderator. We will be bringing you any significant headlines and announcements that come from that as well. But as we wait for hopefully something big, question mark, let's bring in Shan, Chief China Economist at Goldman Sachs. Maybe you can tell us what you're expecting.
I I might as well wait with you and see what exactly they announce. Lots of headlines are coming out of China.
Yeah. Well, what do you think they could say?
I think the basic construct is that last Q4, when they increased the subsidy for consumer trade-in program, you see the impact right away. Auto sales, home appliances sales. So naturally, you want to build on that success and increase the subsidy, broadening out the categories. In China's system, we had the money used up by the end of last year. Now, coming to New Year, everyone's waiting for 2 sessions, giving the comprehensive package of fiscal stimulus. But between now and March, you still need to support the economy. So I think of this as early January, the local government needs guidance from central government how much, what kind of product, because at the end of the day, policies are implemented at the local level.
Do you think that's going to be enough to sort of reignite any sort of consumer sentiment, at least between now and March?
I think you have to do it because this type of a trade-in program, we labeled it as China's cash for clunkers, right? You saw what happened back in 2008, 2009. When you have this program, sales increase, but as soon as the program ended, you have a payback impact, right? Because everyone who's planning to replace their air conditioners, refrigerators, took advantage of the program. So by default, if you want consumption to be stable from Q4 to Q1, you have to do something.
In some way, we can call it trade-in program. It's a subsidized program. So effectively, people are buying at, correct me if I'm wrong, lower prices. Is this contributing to the lack of inflation, you think?
Not mechanically, because let's say if the car is selling at 200,000 RMB and the government give you a subsidy, when you measure CPI, it's still measured at 200,000 RMB.
We're just getting some lines from Movcom right now talking about, China essentially asking the US to stop its wrongdoing. That does appear to be linked to this US military blacklist that some Chinese firms were added to. We had Tencent, for instance, CATL, shipping company, Costco as well, SenseTime, that's an AI firm. How much are these geopolitical headwinds factoring into the conversations that you're having?
Quite a bit. Yesterday, our equity analysts covering these names put out a research report detailing the different type of a list. And for investors, you do have to sort of understand what's the implication specifically. But broader picture, people are concerned about the deterioration in U.S.-China. People talk about tariffs, but beyond tariff, there are other frontiers or areas where you can see this type of negative headlines impacting the market, impacting confidence.
Is this a bigger problem, you think, for domestic policymakers? Simply because it's harder to measure something we don't know yet. So in other words, the counter or the offset that many people are saying they're holding back because they still don't understand how Donald Trump is going to approach this. How much uncertainty does this add actually to the economic equation this year?
Yeah, I do think this is tougher to navigate, even in policymakers' mindset, that domestic issues, because of all the resources, the capabilities of different levels of governments and ministries, they feel more confident to manage versus is from external, from something they don't have control, they can't predict. I do think that adds a layer of complexity and uncertainty. And if you trace it down for investors, if I understand that the government, the Chinese government, is navigating something difficult and potentially there could be unintended escalation, then I get nervous and I want to be more risk averse. So you can see how between the government and investors and the economy, it is a bigger challenge.
And it's certainly a challenge when you're facing market dynamics because China has signaled that it wants to keep some cards up its sleeves and it has the power to fight back. But so far, the defenses we're seeing early, for instance, in the defense of the yuan and in the defense of bonds, urging investors that it's not a one-way bet, isn't really sort of seeming to have much of an impact.
This is, I think, in my client conversations, I can sense this almost Chinese policymakers and foreign investors are not on the same wavelength, in the sense that Chinese policymakers are thinking, to boost confidence, that I need to set a high real GDP growth target. But foreign investors are thinking, if you're going to just achieve the real GDP target, you're going to produce more cars and more machines, and what you really need to do is inflation and nominal GDP. And Chinese policymakers are thinking, if I fix the CNY level, that's confidence, that's stability, that's power. But for foreign investors, they want to see, in fact, from any other free flow currency, you wanted to depreciate. That's easing your financial conditions. That's helping your economy. So a lot of times, I think the intention may be coming from the same place. We want confidence. We want China stimulus. We want China to sort of have a positive spillover on the rest of the world. But I don't think they are talking the same thing.
Since this live briefing reminds me of the one that we had that kicked things off back in late September. So I think simple question for you. Since that point, what's improved in the economy?
I think at the surface, retail sales, auto sales, home appliances sales, it's pretty clear that if you subsidize and the consumers will make a rational choice and things improve, right? We are seeing some. For example, ahead of a Chinese New Year, there's some acceleration in activity because the migrant workers need to finish their work and go back to home. You're seeing exporters front-loading exports, fear of upcoming tariffs. So activity is not that bad. You look at all these indicators. But at the same time, I think investors, judging from the market performance, having to juggle with uncertainties domestically, externally, and also their expectations. They want the government to go all in, whereas Chinese government seems to want to leave more policy room, and that just leaves a bit of a vacuum or disappointment on the risk assets.
And it does seem like maybe the disappointment is accelerating a little bit as well. I mean, I think we've all been tracking the moves in bond yields and that continual slide that we're seeing. There is a concern that maybe we're looking at a situation of Japanification of the Chinese economy. Do you see that at all?
Whether it's Japan or China, I think a lot of the economic principles and fundamentals are similar in the sense that if you have a large amount of debt, right? You look at China, how much debt total outstanding? 300 trillion RMB. For every point of decline in interest rate, that's 3 trillion RMB of interest savings per year, right? So the gravity is that you need to have a lower interest rate to manage debt, to support growth. Whether it's Japan or not, it just seems to be the right direction of a movement. We can't predict whether the yield is going to go up or down next day, next month, but you can see the logic why markets expecting Chinese interest rate to go lower.
Or you grow out of it. Like sometimes growth is able to offset some of the debt load as well. And I guess my question there right now is, are there specific, and I think what's interesting too, it's a little bit of confusion, I'm not sure if you could add more clarity to this. When the PBOC changed their monetary policy stance for the first time, I believe, in 14 years, after already many cuts to various interest rates, after yields have fallen as well, and I'm wondering what further action, future action, does that actually open up? That's number one. And number two is, are there specific policy tools, monetary tools, that are already running, are close to the edge of efficacy, for example?
Yeah, we get this question a lot. Even onshore, there's a debate about whether monetary policy is useful. There's no demand for loans, then cutting interest rate, it doesn't seem to help that much, right? If I don't want to borrow, you give me a 20 basis point cheaper loan, doesn't seem to help that much. I want to emphasize that if you look at all the downturns globally in any other country in any point of history, when it's an economic downturn, demand is weak, banks don't want to make loans, monetary policy transmission will be lower. But that doesn't mean we shouldn't be cutting interest rate. We shouldn't be making it easier. So in that sense, I do think going forward, the PBOC we are expecting them to cut interest rate. Perhaps the timing is harder to predict because of tariff, FX management, all the other constraints. We are expecting them to continue this path of helping on the property sector, helping on the consumption front, and we need easier financial conditions.
All right, Shan, stick with us. We've actually just had the first line coming out from this briefing finally that China will be providing a loan discount for equipment upgrades. So we're going to dig into the details of that just ahead. As we said, Shan from Goldman Sachs is staying with us, but still ahead as well. Hear why Wells Fargo thinks overvaluation of the US dollar is only going to be getting worse this year. We'll get their currency forecast later this hour.
Yeah, ahead of that, though, from absorbing Canada, 51st state, into the U.S., to buying Greenland and renaming the Gulf of Mexico, more on President-elect Donald Trump's latest global policy pronouncements coming up next. This is Bloomberg.
Taking a look at some live pictures here out of Beijing. We've got the NDRC, the PBOC and the MOF holding a briefing on the scope of China's new trade-in program. We've been waiting for lines and we've just got a couple now. The first is that China's going to be providing a loan discount for equipment upgrades. That's one that's more aimed at businesses that could be looking to upgrade their equipment. And also they're going to be covering more consumer items under the trade-in program. That's what we're hearing so far. But let's get back to Shan now, Chief China Economist at Goldman Sachs. And so we were just speaking there in the ad break, and you were explaining some of the nuances of what we had already seen in the white goods program, or what we'd seen in the fourth quarter. It was the business side that had seen a few bottlenecks. So do you think this is sort of about trying to ease those a little bit?
Yeah, it does sound because if you look at Q4, central government allocated 300 billion subsidy, right? 150 for equipment upgrading, 150 for consumer goods trade-in. The consumer goods trade-in program, you see retail sales showing the data is effective. But the equipment upgrading part hasn't, they found some bottlenecks because in this environment, if you have excess capacity and you don't think a business is picking up, you might be reluctant to replace the old equipment for new equipment, even with the subsidy. So I think there's some debottlenecking and lesson learned because this is implemented at the local level. Some regions are more successful than others. Is the application process, is the refunding process, anything they can do to improve how well the programs runs.
I mean, this goes back to the confidence issue, doesn't it? Because effectively, say you give money to consumers or businesses, consumers will just keep them in the bank. And I guess my question is, have they done enough, or have we just not waited enough for these things to actually filter into the real economy?
Yeah, I think what you're mentioning, this permanent income hypothesis in economist language, that if I just give you money one time, you might just pocket it because you know this is just one time. But if I tell you I'm going to give you a raise every single year, then you feel, okay, I can afford it, increasing my consumption. That is why Chinese government has been talking about potentially giving money to households with multiple kids, increasing the basic pension for rural retirees, because you know you're going to get that money month after month. You should feel okay to increase your consumption on a permanent basis. So I think this type of a program seems to be in the pipeline, but we do need to wait a little bit because it's brand new. It's something, a big program. You need to think about the design, the implementation, and the rollout.
And I think recently, I was off, maybe you saw the story. I think didn't China increase the wages for government officials?
Yeah, they did. Yeah, I think
but there was no big official
month.
Announcement, though, on that.
No, I don't think it's actually been confirmed. I think it was our Bloomberg reporting.
Right.
And it's around 68 or 70 US dollars a month. But it is the first wage gain that we've seen in a number of years.
Yeah, I mean, so what's the outlook for your outlook for wages, both public and obviously separate private sector?
Yeah, so the labor market data are not the best in China, but to an extent you can track PMI's employment sub-index. To an extent you can look at various wage indicators. Labor market is facing pressure. It is difficult to find good paying jobs. So if I just look at aggregate level, government giving money or increasing wages of civil servants, that helps aggregate demand. Whether that's going to be enough or not is another story. But I think now the key question is to make sure whatever stimulus, monetary, fiscal, we have enough of support because to really kick the inflation into a positive trajectory and kick confidence from a downbeat to more upbeat.
Just another line coming from this briefing is that China's looking to raise subsidies for consumer trade-in to 20% of price. What's your reaction to that? And just second to that as well, looking a little bit longer term, 12 months from now, do you think the Chinese economy is going to be in a better position than it is today?
Increasing the subsidy, so this is I assume at the central government level, and local government can also chip in and increase the subsidy. And by broadening the type of a product eligible for trade-in and increasing subsidy, that should help increase retail sales of these products and therefore help consumption and growth overall. To your question, 18, 20 months down the road, what are we looking at? I think it really depends on whether we see signs of stabilization in the property market, whether we see the signs that the deflation in PPI start to narrow and start to move into a positive territory and companies are making money and fundamentals are improving. So a lot of uncertainty. We talk about tariff and we are having our macro conference next week here in Hong Kong. We'll have speakers specifically addressing U.S. policy and tariffs. So you can see a lot of the pieces need to fall in place for us to see a fundamental shift.
All right. And as always, we look forward, of course, to the updates from the Goldman economics team and research team. I get that regularly. Thank you so much, by the way. Shan, their chief China economist at Goldman Sachs. Have a great 2025 ahead. Right. On the geopolitical part of the conversation, which is very difficult to quantify, of course, you had U.S. President-elect Donald Trump out with some fairly hefty statements here. So declining to rule out military force to seize Greenland and the Panama Canal, threatening tariffs on nations that don't cooperate. Panama has already, in fact, vowed to not give up the shipping channel. Denmark's part of the conversation now and says that while it welcomes U.S. investment in Greenland, the world's largest island is not for sale. And we haven't even talked about Canada. Jill Deeses, our news desk editor, joins us right now. What stood out to you among this fairly hefty list?
I mean, I think that at this point, David, it's really just a question about how much. I mean, and we were having these conversations, 5, 6, 7 years ago when we were working through Trump's first term in office. But it really comes down to a question of how much of this is just rhetoric and trolling versus actual policy, right? And I think that while, this is something that we certainly did experience during Trump's first term in office, the key difference there was that, he lost the popular vote in the United States. He didn't have maybe quite the same mandate that maybe he feels now, and you also had people that were surrounding Trump within his first administration that I think from the outside certainly looked like a bit of a check on Trump. There were a lot more moderate Republicans or people who might have been even anti-Trump at various points. Of course, we saw during that administration, how many of those people were ultimately forced out. This time around, it's just a completely different story. I mean, he's won pretty decisively the popular vote in the Electoral College, is coming in maybe feeling much more of that mandate. And so when he makes a lot of these really, sort of out there, promises or talks about these things at his rallies and these speeches and everything like that, whether it be, basically taking territorial control over, different places for the first time. I think that would be the first time in the United States since Truman in 1947 actually taking, control of other territories. I mean, when he says those things, I'm not sure that there's any practical way for him to move forward with that, but I think it does kind of reflect a shift in tone and rhetoric, and I think, opens a lot of questions as to what Trump administration on forest policy may actually end up looking like this time around.
Yeah, really trying to figure out, is it more bite than bark, or other way around? But anyway, we'll be, of course, listening to all those press conferences. That was our Bloomberg desk news editor, Jill Deeses there, and we'll have plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. Appliance stocks or related stocks here. And as you can see, some of the very retail-oriented names here. So the reason we're looking at this, and as you can see, we're moving against the grain here, broader weakness in the equity markets. We're still on top of this ongoing briefing in Beijing between the related ministries talking about how they're looking, at least now that we have a number coming through, they'll be raising some of the support for the consumer trade-in to 20% of the actual price of the actual thing. And as you can see, that's actually worked out quite well as far as the consumption trade-in has gone, as Goldman Sachs was pointing out as well. That's really one bright spot that's really picked up last year. And it looks to be that is sort of set to continue going into 2025. By the way, this is still an ongoing briefing, so we'll keep you guys on top of the story. The other sort of sector we're tracking here are some of the senior-focused related equities on the back of this plan that China is looking to put in place, I believe, in a couple of years and accelerate that into the mid-2030s to effectively support the elderly network, including getting robots to basically take care of old people.
Yeah, that sort of automation is certainly a key area, and it's been one of the key talking points at CES, actually. But let's take a look at how chip makers are going today, and we've seen Samsung reversing some earlier losses. Nvidia founder Jensen Huang has come out to say that they can make progress, or they are making progress in developing their HBM chips. These are ones that are critical to AI infrastructure. You're seeing that coming through. And then also taking Renesas, we've got local media reporting they're going to be cutting jobs, but this is a legacy chip maker. It's 11:29 a.m. in Tokyo. Japanese markets just about to go onto their lunch break this morning. Taking a look at how stocks are faring in. Look, it's not such a great picture today, but a little bit unsurprising because we had Wall Street dropping overnight and concerns really around the Fed not being able to cut rates as soon as expected and a shallower easing cycle. So that's certainly playing into it. And we saw big drops, for instance, in tech overnight. I think Nvidia, for instance, was down around 6%, but that's also because people are a little bit disappointed by what Jensen Huang had to say at CES. But that is Japanese markets there. Taking a look at what we're seeing broader Asia this morning, because it is that sort of trend, that follow-on that we're seeing across the board here. Yeah, you've got pretty much every single sector in the red. The only thing standing out actually is US futures that are pushing a little bit higher here today. But it is, again, that story of the Fed, shallower easing. And also, I mean, the dollar dynamics have certainly been playing into Asian equities.
Yeah, that's a terrible visual right there. I mean, it says it all, right? And then S&P futures are steady, which is really the story so far of the last, 3 months or so. I mean, to Belle's point, right? And the reason I think we're looking at this sort of pain point across these markets. And by the way, in 16 days, guess what? 16 days, the BOJ decision, having to contend with the fact that of this dollar strength. And to Belle's point, right? Coming into this year, the expectation was the next cut from the Fed would be in March. The repricing that's taken place has now pushed that back. The full rate cut currently priced now for July. You have to wait for the summer for that to take place. That's a moving target, of course. But as things stand, markets are pushing that back going into now the second half of this year. Point number one. Point number two is really just another way of saying this. When you have your 5-year forward 1 year, which is effectively expectations in 5 years of where the rate is going to be, the 1 year rate is going to be. And as you can see, we're now at 4.2% as far as that is concerned, up 120 basis points from September. So that repricing that's taken place has taken you all the way back almost to 4.5%, right? So that showed up in this form of stronger, higher yields and a stronger dollar, which is still a source of a pain point. And this gets us nicely into our next guest, which is coming soon. Very, very quickly, I'll end on this, though. We're at 103, 1,300 on the Bloomberg Dollar Index. What I want to point out, though, is momentum, right? So that's when you had the rate hiking cycle from the Fed. This is the 14-week relative strength index. And as you can see, that's been above this 50 handle for the most part of those, give or take, 2 years. Have a look at where we are. So the momentum in the force, Bell, is strong with this dollar.
All right, Dave, well, you preface that we've got a guest coming up. We've got Chidu Narayanan. He's APAC head of macro strategy at Wells Fargo, joining us this morning. And Chidu, we'll start off with what Dave was just saying there. It seems like the forces are really aligning to continue to see dollar strength from here.
Indeed, that's right. We think that that's going to be the theme of the year for yet another year. We think that the dollar is going to be stronger, FX war is going to be higher. We possibly think that dollar is going to be another 3-4% higher from current levels. And if you look at the different scenarios, you have one, strong data in the US, which means that the theme of US exceptionalism continues. US is still going on steady while the rest of the world is softening in different at different degrees, which means that the dollar is going to be stronger. You have the Fed expected to be easing far less than what markets thought last year, while other central banks are continuing to ease, with the exception of the BOJ, which again means that rate differentials work in favor of the dollar. And you have a lot of the risks on the horizon. You have uncertainty on policy, uncertainty on trade, uncertainty on geopolitical tensions, all of which will increase risk aversion as and when that happens. And that, again, adds to a higher dollar. So in all roads lead to a stronger dollar for the year ahead.
Chidu, David here. It's horribly overvalued, though, currently. Sort of the reason I bring that up is that, is valuation a useful indicator short term when they look at the FX markets?
Indeed, we don't think it's really overvalued per se. See, when we're talking about dollar being stronger through the year, it's not going to be a straight line appreciation of the dollar. It is going to be driven by data. It is going to be driven by central banks speak. It's going to be driven by events. But 6 months down the line, 1 year down the line, we think that the dollar is going to be higher than where it is right now. Tomorrow, if there's going to be an event risk, if data is going to be softer, then the dollar could be marginally softer. But even in a scenario where US data starts to deteriorate, starts to show off, give away some of its strength, that could raise market worries about a significant recession. We think that the risks of a substantial slowdown, a global slowdown, is very, very underpriced, which then means that there's yet another reason for the dollar to be stronger.
Yeah, I guess sometimes it's a question of whether the dollar is really reflecting the fundamentals. But you mentioned that risk that maybe we see a global slowdown. Which currency do you think looks most exposed in that sort of environment?
Right. We'll need to see how exactly the slowdown itself happens and whether it's a tariff-driven slowdown or whether it's a global demand-driven slowdown. In all scenarios, the dollar is generally stronger, and we think the yen is probably a little bit more resilient amongst the majors, amongst the G10. The yen being a bit of a risk haven, a risk-off currency, will still depreciate against the dollar, but possibly not as much as, say, the likes of the euro or the Aussie. We also think that the CNH and Northeast Asian FX, EMFX in general, is quite vulnerable to a stronger dollar, weaker global growth, tariff risks when that's imposed. And if the CNH is going to be weaker, then that means that a lot of the high beta currencies, the likes of Korean won, the likes of Latin American FX, would also be that much more weaker than the CNH itself.
Yeah, Chidu, I think you are one of the long trade recommendations you're making is long the yen against the won. Do you have a timeline for that? Do you have a target for that specific pair?
See, we've been short the won for a while now, for a couple of months now, and we entered this trade pre-election, late October, and it's worked fairly well so far. The reason why we like to pair the yen and the won together is gives you the ability to hold on to that trade for the longer term. The yen's likely to be underperforming against the dollar, but still a bit more resilient. The won, we think, could be heading closer to 1,500. This is irrespective of the political tensions that are onshore. Growth is generally weaker. The BOK has moved its focus from inflation to growth as inflation has started to be a little bit more contained. And if, again, the CNH is going to 760, as we expect to happen over the next few months, then that means that the won's going to be much further exposed in that scenario. So we think that the dollar won probably goes to 1,500 through to the end of the year, and yen won possibly could be heading towards 980 or 10.
What about your dollar yuan forecast? Because you just mentioned those there. We could see, for instance, 7.6 on the offshore by the end of the second quarter of this year. What do you make then of that sort of pushback that we're seeing from the PBOC?
Actually, this was exactly how we had expected, how we had anticipated that to happen. We think that the yen is going to be weaker purely because of a lot of domestic weakness that you've been talking about also, and we've been talking about for a few years now. Not too much has changed on that front. The domestic weakness still persists. A lot of the activity onshore is driven by external support by the export environment. And that might start to weaken as global demand possibly starts to slow down, as tariffs start to kick in. All of that is going to be weakening. So we think that the yuan is going to be softer purely from a domestic perspective. Layer to that the stronger dollar, increased risk aversion because of tariffs. We think that dollar yen goes to 760 by second half of or the second quarter, and 770 by the second half of the year. Again, the PBOC is going to be stepping in. They don't want an completely unruly depreciation from the CNH. They want dollar CNH to be higher, but they want it to be very contained. So they will use up all their tools. They've used counter-cyclical adjustments in the fixing. They've pushed up the CNH HIBOR, making liquidity tighter. We're seeing the fixing error now close to about 1,1500 pips, which is as high as it was in the early part of last year. And we've seen a very strong correlation between that fixing error, which is the PBOC pushing back against weakening expectations on the fixing, and the strength of the dollar itself. The DXY and the fixing error seems to be going 1-to-1, and a higher dollar, much stronger external headwinds for a weaker CNH, the more the PBOC will be pushing back against slowing down the depreciation, but not changing the direction of depreciation.
Yeah, Chidu, I'm curious because we're showing now a graphic, you probably see it on your screens too, of the point you just made, CNH HIBOR surging yesterday. And, well, I wonder, do you think this is the PBOC at work? Did they intervene in markets yesterday? Did they squeeze the shorts?
See, we've seen this play out in the past. The chart you had shows 2021. You see 2016, 2017. You had it probably pales in comparison, this tightening that we're seeing this week compared to what happened in 2016, 2017. So yes, there are a ton of tools that the PBOC can use to dissuade significant one-way depreciation expectations. So we think that the PBOC does not want a stronger CNH. They just don't want weaker CNH to be unruly, and they don't want expectations of one-sided depreciation to be setting in. They've been fighting back against market expectations of one-sided depreciation for several years and have had success over the last few years. You don't want to be letting go of that success in your bid for a weaker FX.
Absolutely, yeah. To your point, if we take the chart back to 2015, you barely see what's taken place yesterday. Chidu, fantastic stuff. Thank you so much. Chidu Narayanan, their head of macro strategy, APAC, at Wells Fargo, head of macro strategy for the Asia Pacific. Coming up, a Chinese actor who went missing near the Thai border with Myanmar last week has finally been found. We'll track the online chatter next. This is The China Show.
Taking you back to some live pictures here out of Beijing this morning. We've got the NDRC, the PBOC and the MOF briefing on the scope of China's new trade-in program. So we're getting details of this filtering out through the hour. But the headline that's just dropped now is that China is going to be subsidizing smartphones for up to 15% of price. So that means that essentially the companies can still book 100% of the profit, but China is essentially paying for part of those devices. Has that really been enough? Well, the market reaction so far, I was just taking a look at Xiaomi, for instance. Its stock is down more than 3% this morning, following from a near 6% slide yesterday. So it doesn't really seem to be exciting enough for markets so far, Dave.
Yeah, well, how many phones do you need? It's time for what's trending in China. A look at the stories making headlines in national newspapers and grabbing attention on social media. Leading today's news coverage is President Xi's call for all-out rescue efforts following the deadly earthquake we talked about in the last hour in Tibet. Now, that story is actually occupying half of the People's Daily's front page. Now, state media reports that Xi has also urged officials to strengthen earthquake monitoring and early warning and speed up the repair of damaged infrastructure. Now, the paper is also calling on party members to be at the forefront of disaster rescue and relief.
All right, the Shanghai Securities News also says Beijing is likely to implement forceful monetary policy moves this year. Experts cite recent government pledges to lower interest rates and banks' reserve requirement ratios. One economist sees the RRR being lowered by 1 percentage point and interest rates to go down by 40 to 50 basis points. An analyst, meanwhile, sees a RRR cut this month.
Right. To the other story that's been making waves across Chinese internet, of course, you might have seen it already. So you have people been obsessing over stories, including this, the tale of an actor, a Chinese actor who went missing last week near the Thai border with Myanmar. Now, he was found on Monday and has now been handed over to Thai authorities. Let's bring in Rebecca Choong Wilkins, of course, here with us to talk us through why this case has just drawn so much attention, Rebecca.
Well, so just first and foremost, it's actually not a particularly famous actor. So that's not really what's actually garnering attention. It's the circumstances of his disappearance that has captivated people's imagination. So he was in Thailand apparently to film a television shoot, but he went missing in this border town between Thailand and Myanmar. And that triggered this wave of speculation that he may have been somehow lured into one of these scam centers linked to cybersecurity fraud that is pretty rampant both in Myanmar but also elsewhere in Southeast Asia. His girlfriend actually sort of drew attention to his disappearance, saying that she'd been in contact with him in Bangkok, he'd gotten into a vehicle and he disappeared at this border town. Now, Thailand, including the Thai leader, have actually sort of come out to quite robustly try and combat the fallout of this. Chinese tourists really important for the Thai economy, of course, saying they have to be very careful about managing this and that no Thai nationals were involved, and in fact Chinese nationals may have been involved. And it's worth pointing out this is actually really sort of a topic of popular culture in China. A couple of years ago there was this big blockbuster about Chinese nationals that were lured into a Southeast Asian nation for one of these similar scams. It was a crime thriller that did really well in China. Over the last couple of years we've seen thousands of Chinese nationals arrested in Myanmar and elsewhere for their involvement in these schemes. Authorities are quite active about broadcasting their success in cracking down within China. So I think for that audience and for the Chinese internet, this is really a topic that resonated and that some people feel is perhaps a real risk if they go on holiday to Bangkok.
Something else that's grabbing a lot of attention on social media, and maybe not for the reasons we might expect, is this surge that we're seeing in HMPV cases. I won't actually try and pronounce the scientific name of that, but it's something that's been around for a long time. It's just not really that well known. So why is it grabbing so much attention now, do you think?
Yeah, this is really interesting. So HMPV, it has been around for a while, first discovered back in 2001, but not enormous amount known about it. It essentially produces flu-like symptoms. It's relatively mild, but Chinese authorities are saying that it is the main driver of respiratory illnesses as well as hospitalizations over this winter illness period. Now, they've caveated, saying that actually overall levels of winter illness are not as bad as last year. But, of course, because of the criticism around Beijing's handling of the pandemic, particularly in those early stages, criticism of the transparency, there is this alarm that has been triggered in part online, but also in China and abroad, of course.
How quickly is it spreading?
So far, it seems we are finding more cases across Asia. So we found cases in recent days in Hong Kong, Malaysia, India. But Asian governments are warning, let's not be too alarmist. And one reason might just be that we are discovering more cases because virus detection has become so much better since the pandemic. So for context, at one point it might have taken a few days to actually test for HMPV. Now it's a matter of hours, if not less than 1 hour. And so part of the identification of how quickly this is spreading and where we're seeing it is partly just because of improved methods of detection.
All right, well, certainly, it's not good news for people, but if you're a holder of those stocks, we are into a second day of gains for the flu-linked names today. But that was our Asia economy and government correspondent, Rebecca Choong Wilkins there. Up next, we're going to be hearing from Nvidia's CEO, Jensen Huang, on the company's latest slate of consumer-grade products, as well as a potential meeting with Donald Trump. More ahead. This is Bloomberg. Well, and Nvidia shares, they really slumped on Wall Street overnight. There was not only sort of a broader risk of sentiment, but there was also what we heard from Jensen Huang at CES, and mainly that he kind of failed to win over investors in the AI chip maker. Huang, after that, also spoke to Bloomberg Tech about plans under incoming President Donald Trump, as well as the impact of AI on the gaming industry.
AI is going to reinvigorate the video game industry. On the one hand, for developers, it's going to reduce the cost of creating the content. On the other hand, all of the characters that are in the games are going to be smart characters in the future. So every time you interact with them, they're going to be interacting with you in a much more intelligent way. And so the games are going to be more interesting. The characters are going to be more interesting. The content development cost is going to decline. And that's going to be really great for the industry. And so I think that the future is really bright for video games and these virtual worlds. And artificial intelligence is going to really reinvigorate it.
Project Digits. May I pick it up?
Yeah.
$3,000 Project Digits.
Yeah.
A supercomputer you can
sitting
put on
right
your
next.
desk.
Exactly. Could you imagine you're just sitting there just like that? You're working on your PC.
Well, I can't imagine. Why would I need one of these? Probably not me. But how big is the addressable market for this? What is the addressable market?
There are 30 million software developers. There are probably something along the lines of 10 million designers around the world. Probably another 20 million creative artists. Hard to say exactly how many students. I'm going to guess probably a couple of 100 million students around the world. Everybody's going to have to. Everybody's going to have to. Well, they can afford computers, and so if they can afford computers and they would like to have a companion that helps them do AI, this is the way to do it.
Can I just clarify something on it? I think you said on stage. Mac OS, Linux, and Windows, but the communication said just Linux.
No. Whatever computer you use, you're literally enjoying how it's going to be used. It's sitting right there, and you just connect to it wirelessly like it's your personal cloud.
I promised the audience I'd clarify that because they're excited. We're running short on time. President-elect Trump has been speaking during the course of the conversation. How imperative is it that you go to Mar-a-Lago and meet with him if Nvidia is America's leading AI company? And will you?
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
A lot of what you outlined on stage last night in the realm of physical AI, I saw Xpeng, for example, in the autonomous driving context. That's happening in China. Like, they are doing a lot on robotics. So I'm going to ask you about tariffs. It's likely this coming administration will be as restrictive on technology export, and tariffs will be a function. How have you prepared for that, Jensen?
Whatever the administration ultimately decides, we'll give them as much insight as we can from our perspective. And I'm sure that the administration will make the right moves. That's in the best interest of our country.
Yeah, there we go. Our colleague Ed Ludlow with Jensen Huang there speaking just this week, of course, following the keynote speech. Right, back to China, back to this ongoing briefing. So on an index overall basis, what's been said so far hasn't really moved the needle overall. But you are getting bits and pieces across certain sectors that are moving on the back of some of the announcements, including the latest headline to come through is that China will be allocating 100 billion renminbi, do that in US dollars, of course, 7.3 rather, for some small tech firms. That's according to the PBOC, among other things that have been announced.
Yeah, and actually just sort of thinking about the broader tone of markets, really, we've actually seen the CSI 300 sliding throughout this hour. So, there hasn't really been enough to sort of stoke investor interest. But taking a look at what's happening in the home appliance stocks as well, because, again, there's been some moves here. Essentially, China is saying that they're going to be raising subsidies for consumer trade into 20% of price. So this actually is a bit of a brighter spot. I mean, and we have seen that trade-in program having success so far. It's just been that question of how frequently you're going to be upgrading the white goods, but that's still an expansion of it, and also some things to sort of make changes to things that hadn't been working so far in the system as well in terms of businesses. But that's it from Bloomberg.